Physical silver, vanishing from NY vaults faster than ever. China still paying $9 premium 200 million ounces, sitting in New York vaults just 5 months ago. Today, 88 million, gone. And China is paying $9 extra per ounce every single day to pull it out faster. The question every serious investor should be asking right now is not where the silver is going. It's what they know that you don't. Welcome to Financial Crisis Explained, on the one place where the numbers speak and the narratives get left at the door. Now, before we go any further, if you found this channel today, think of it like finding a good doctor, a trusted one. After years of getting the wrong prescription, you don't walk away from that. So if you're someone who's spent decades watching the system, sensing something was always slightly off, but never had the receipts to prove it, hit that subscribe button. Not for us, for yourself. Because the information coming in this video is exactly the kind they stopped teaching a long time ago. And while you're here, drop in the comments, where in the world are you watching this from? Are you in the United States, Middle East, Asia? Because what happens in these vaults affects every single one of you differently. Now, let's get into what the data is actually showing. There's a number that should be making headlines across every major financial publication in the world right now. That number is 88 million. 88 million ounces of registered silver sitting inside New York's COMEX vaults. That sounds like a lot, until you realize that just 5.5 months ago, that number was 200 million. Let that sink in for a moment. In less than 6 months, 111 million ounces of physical silver have quietly, systematically, and almost silently left the most important commodity vaults in the Western world. No major announcement, no emergency press conference, no breaking news alert. Just the data sitting there, waiting for someone to read it seriously. Now, here is where it gets important for anyone watching this who runs a business, manages capital, or simply refuses to be the last person in the room to understand what is happening. The COMEX, the Chicago Mercantile Exchange, is not just a trading platform. It is the backbone of Western silver price discovery. When institutions, manufacturers, and sovereign entities need to take physical delivery of silver, this is where they come. These vaults are not a suggestion. They are the foundation. And right now, that foundation is draining at a rate that has no modern precedent. The math is straightforward, and that is precisely what makes it dangerous to ignore. From September 2024 until today, registered vault holdings have declined by an average of 20 million ounces every single month. 20 million ounces every month. Gone. Now, layer on top of that one critical data point that most analysts are glossing over entirely. The March delivery cycle on COMEX is currently rolling at 15 million ounces per day, but the market requires 30 million to function without stress. Half the requirement every day. And at the current depletion rate, the registered inventory does not survive the quarter. This is not speculation. This is arithmetic, and arithmetic does not negotiate. Now some will immediately raise the eligible category, the silver held in vaults that has not yet been formally registered for market delivery. It is a fair point. Eligible silver can be transferred into registered status. It has happened before. But here is what that argument misses entirely. Registered vault holdings represent the net position. Inflows minus outflows. Every ounce leaving registered inventory is already accounting for whatever transfers from eligible are occurring. The fact that registered is still declining this rapidly means the outflows are overwhelming the inflows. The pipeline is not keeping up, and no amount of eligible silver reclassification has been sufficient to slow the drain. So the question serious people must ask is this: who is taking delivery? Who is pulling physical silver out of New York vaults at this pace? And why now? Because commodities do not move like this without reason. Physical metal does not vanish from the world's most liquid silver market because of a seasonal trend or temporary arbitrage play. When registered inventory collapses by 55% in 5.5 months, something structural is happening beneath the surface. And here is what makes this moment particularly significant for the business community watching this video. The entrepreneurs and executives who will be least affected by what comes next are not the ones with the most money. They are the ones who read the data earliest. History has shown this repeatedly. The 2008 crisis did not surprise the institutions that were watching the mortgage default data quietly accumulating in the background. The COVID supply chain collapse did not surprise the manufacturers who had already been monitoring shipping container shortages 6 months before the mainstream acknowledged them. The pattern is always the same. The data speaks first. The headlines come later, and by the time the headlines arrive, the window has already closed. Right now, the data is speaking. 111 million ounces of physical silver have left New York vaults in 5.5 months. And as we're about to show you in the next part of this analysis, the entity absorbing that silver is not who most people expect. And they are not buying at the Western price. They are paying extra, a premium so consistent, so deliberate, that it stops looking like a market inefficiency and starts looking like a strategy. China is not speculating. China is positioning. There is a rule in global markets that every serious business person eventually learns. When someone is willing to pay more than the market price, consistently, deliberately, and at scale, they are not making a mistake. They are making a move. Right now, on the Shanghai Futures Exchange, silver is trading at $86 spot, futures at $80. Meanwhile, in New York, Western spot sits at $77, futures at $77. Same metal, same element, same periodic table entry, Ag, atomic number 47. And yet, China is paying $9 more per ounce. Every single day, not once, not twice. Every single day. Now, in any functioning, efficient global market, this gap should not exist. Classical economic theory is very clear on this. When the same asset trades at two different prices in two different locations, arbitrage kicks in automatically. Traders buy where it is cheap, sell where it is expensive, and the gap closes. That is how markets are supposed to work. But that is not what is happening here. The gap is not closing, it is not narrowing. In fact, it has been widening. And that one fact alone should stop every serious analyst in their tracks. Because when arbitrage fails to close a price gap of this magnitude, it means one of two things. Either the physical metal cannot move freely between the two markets, or the demand on one side is so overwhelming that no amount of supply flowing toward it is sufficient to bring prices back into alignment. In this case, both are true simultaneously. Let us go back just a few months. When silver was trading below $30, the Western to Shanghai price premium was approximately $3. $3, manageable, explainable, the kind of gap that traders shrug at over morning coffee. Then silver ran. It pushed past $100, it crossed $120, and as it did, something extraordinary happened in the background that almost nobody in mainstream financial media bothered to report. The premium did not shrink as prices rose. It exploded from $3 to $18, a 500% expansion in the price gap, at the exact moment when Western vaults were hemorrhaging inventory. This is not coincidence, this is correlation with intent. Here is what that data combination is actually telling the informed observer. As silver prices rose in Western markets, the logical expectation would be that Chinese buyers would slow their purchases. Higher prices typically suppress demand. That is economics 101. But China did not slow down. China accelerated. They did not flinch at $86 when New York was offering $77. They did not renegotiate. They did not wait for a dip. They paid the premium, absorbed the supply, and kept going. That behavior has a name in strategic economics. It is called price inelastic demand, and it only appears in one specific scenario, when the buyer is not purchasing for profit, but for security. Now consider who else has recently entered this market with the same urgency. The military-industrial complex, an entity that does not speculate, an entity that does not chase trends, an entity that acquires what it needs when it calculates it will need it, regardless of price. Silver is not decorative in modern defense and technology infrastructure. It is functional. It is inside missile guidance systems, satellite components, advanced electronics, renewable energy infrastructure, and next-generation communication technology. When the military-industrial complex becomes what analysts are now calling an insatiable buyer in the silver market, it signals something the quarterly earnings reports will never tell you directly. A structural, long-duration demand shift has begun, and this brings the serious business person to a question that cannot be deferred. If China is paying a consistent $9 premium, and the military-industrial complex has entered as a structural buyer, and New York vaults have lost 111 million ounces in 5 months, then who exactly is left holding paper or silver contracts? Assuming physical delivery will always be available on demand? Because here is the reality that the data is quietly assembling into a very uncomfortable picture. The Western silver market has been operating for decades on a fundamental assumption that registered physical inventory will always be sufficient to backstop the paper contracts written against it. That assumption is being tested right now in real time with real numbers that are moving in one direction only. And in part 3 of this analysis, we turn to the institution that is supposed to stabilize moments exactly like this one, the Federal Reserve, which just quietly injected $18.5 billion overnight, the 4th largest emergency liquidity move since the entire global economy shut down in 2020. question is not whether that number is significant. The question is, what were they responding to that they have not yet told you about? $18.5 billion overnight, and nobody asked why. There is a particular silence that precedes financial turbulence. Not the silence of calm, not the silence of stability, but the silence of institutions, moving very large amounts of money, very quietly, hoping nobody connects the dots. On a night that received almost no mainstream coverage, the Federal Reserve injected $18.5 billion into overnight repurchase agreements, overnight repos, the financial system's equivalent of an emergency pressure valve, a mechanism designed for one specific purpose, to prevent the plumbing of the financial system from seizing up entirely. $18.5 billion in a single night, the fourth largest such injection since March 2020, since the moment the entire global economy stopped breathing. Now here is what most people do not understand about overnight repos. They are not routine. They are not administrative. When the Federal Reserve steps into the overnight market at that scale, it means something in the financial system's short-term liquidity infrastructure demanded an immediate response. Something was tightening. Something was stressing. Something was signaling that without intervention, the cost of short-term borrowing was about to spike in ways that would ripple outward into every corner of the market simultaneously. The Federal Reserve does not volunteer that information. They release the number. They do not release the story behind the number, and that gap between the data they publish and the explanation they withhold is precisely where serious analysts must focus their attention. So let us build the picture methodically, because nothing in this analysis exists in isolation. Every data point connects to another, and when they are assembled correctly, they stop looking like separate market events and start looking like chapters of the same story. Chapter 1. COMEX registered silver inventory collapses from 200 million ounces to 88 million in 5.5 months. The vault is draining faster than at any recorded point in modern market history. Chapter 2. Shanghai continues absorbing physical silver at a $9 premium over Western prices, a premium that expanded from $3 to $18 as silver crossed $120, defying every classical arbitrage mechanism. Chapter 3. The Federal Reserve injects $18.5 billion overnight, fourth largest emergency liquidity operation since COVID. 3 chapters, 3 separate data points, 3 institutions, COMEX, Shanghai, and the Federal Reserve, all registering stress signals within the same compressed time frame. Now, a conventional analyst might look at each of these individually and construct a separate explanation for each one. COMEX drainage, seasonal delivery cycles, Shanghai premium, regional demand fluctuation, Fed repo injection, routine liquidity management. Each explanation, in isolation, sounds plausible, and that is precisely how systemic risk hides in plain sight. It disguises itself as a collection of unrelated, individually explainable events, right up until the moment they converge. But there is a mechanism connecting all 3 that the data reveals when examined together. It is called the paper-to-physical divergence. For decades, the global silver market has operated on a foundational leverage model. For every ounce of physical silver sitting in a registered vault, multiple paper contracts have been written against it. Futures contracts, options, synthetic positions. The system functions as long as the majority of contract holders never simultaneously demand physical delivery, and for most of modern financial history, they did not. Most participants were speculators, traders chasing price movement, institutions hedging currency exposure. Physical delivery was the exception, not the rule. But something has changed, and the overnight repo injection is the Federal Reserve's fingerprint on that change. Here is why that matters structurally. When physical demand begins overwhelming the paper system, the entities holding leveraged short positions in silver, primarily large financial institutions and bullion banks, begin experiencing what traders call a squeeze. Their paper obligations start demanding real metal as collateral. Metal that is increasingly not there. To cover those positions, they need liquidity. Immediate liquidity. The kind that does not wait for quarterly fundraising cycles, or board approval, or market open. The kind that requires a phone call to the one institution that can create it overnight. 18.5 billion, fourth largest since COVID, and not a single mainstream outlet asked the most important question. What position was large enough, stressed enough, urgent enough to require that scale of overnight intervention in a market that was supposed to be functioning normally? The answer sits at the intersection of draining vaults, a $9 Chinese premium, and a leverage model that was always built on one quiet assumption, that physical silver would always be available when the paper finally had to be settled. That assumption is now being pressure tested in real time by forces that do not negotiate, do not wait, and do not accept paper as a substitute for metal. And in part 4 of this analysis, we move from diagnosis to decision, because understanding what is happening is only half the equation. The other half is knowing what the informed business person, the serious entrepreneur, the capital-aware decision maker does with this information before it becomes tomorrow's headline. Because by the time it does, the window will already be closed. What serious decision makers do before the data goes mainstream? There is a moment in every major economic shift that only becomes visible in hindsight. Historians call it the inflection point, the precise moment when the data was already telling the full story, but the majority of people were still listening to the narrative instead. That moment is not coming. It is not approaching from a distance. According to everything this analysis has assembled, that moment is now, and the difference between the business person who reads this correctly and the one who does not will not be measured in intelligence. It will not be measured in resources. It will be measured in one thing only: timing. History is extraordinarily consistent on this point. Let us not speak in abstractions. Let us speak in precedents. In 2008, the mortgage default data was publicly available, delinquency rates were climbing, inventory of unsold homes was accumulating, credit default swap volumes were expanding at an unsustainable pace. The data was not hidden, it was not classified, it was sitting in quarterly reports, in Federal Reserve bulletins, in obscure but accessible databases, waiting for someone to read it without the filter of institutional optimism. A small number of fund managers did exactly that. They positioned accordingly. And when the system finally acknowledged what the data had been saying for 18 months, those managers did not panic. They had already made their decision, long before the headlines arrived. In 2020, shipping container availability data began deteriorating in late 2019. Port congestion metrics were flashing. Manufacturing lead times from Asia were quietly extending. The supply chain collapse that shocked the mainstream business world in 2021 was already visible in the logistics data 12 months earlier. The manufacturers who read those signals front-loaded their inventory, diversified their supplier base, reduced their dependency on single corridor shipping routes. When the crisis became public, they were not scrambling. They were supplying the companies that were. The pattern does not change. Only the asset class does. And today, the asset class is silver. And the data points assembled across this entire analysis are not subtle. They are not buried in footnotes. They are loud for anyone trained to listen to numbers instead of narratives. So what does the informed decision maker actually do with this information? Not theoretically, not philosophically, but practically. First, they separate the signal from the noise. The signal here is structural and multi-sourced. COMEX registered inventory down 55% in 5 months. Shanghai paying a consistent $9 premium that expanded sixfold as prices rose. Federal Reserve deploying 4th largest overnight repo since COVID. Military-industrial complex entering silver as a structural long-term buyer. 4 independent signals pointing in the same direction simultaneously. That is not noise. That is a pattern. And patterns of this coherence in commodity markets have historically preceded significant price and supply dislocations. Second, they assess their exposure. Every business that operates in manufacturing, electronics, renewable energy infrastructure, defense supply chains, medical technology, or any sector where silver is a functional input needs to ask one question immediately. What is our silver dependency, and what happens to our margins? If physical availability tightens by 30% over the next 2 quarters, that is not a hypothetical question designed to create anxiety. It is an operational risk assessment, the kind that separates businesses that survive supply dislocations from businesses that get restructured because of them. Third, they think in terms of optionality, not prediction. The serious business person does not need to know exactly when COMEX hits 0. They do not need to predict the precise date of a silver delivery failure. What they need is to structure their decisions in a way that benefits from being right early and limits the damage of any timing imprecision. That is what optionality means in practice. Physical silver allocation as a balance sheet hedge is not a speculative bet on price. It is insurance against a scenario that the data suggests is no longer hypothetical. Fourth, they study the premium signal as a leading indicator. The $9 Shanghai premium is not just a price gap. It is a directional vote, cast in real capital, by the world's largest physical commodity consumer, when the world's largest buyer of physical silver is willing to pay 12% above Western spot prices, consistently and at scale. They are not making a trading decision. They are making a decade-long infrastructure decision. And the business person who aligns their own strategic thinking with the directional bets of entities operating on that time frame is not following the crowd. They are following the evidence. Fifth, and perhaps most importantly for the entrepreneurs watching this, they resist the comfort of consensus. The most dangerous phrase in business is not, "I don't know." The most dangerous phrase is, "Everyone says it's fine." Because everyone said the mortgage market was fine in 2007. Everyone said supply chains were resilient in early 2020. And right now, everyone in mainstream financial media is not asking why 101 million ounces of silver quietly left New York vaults in 5.5 months. They're not asking this because the question leads somewhere uncomfortable. It leads to a conclusion that disrupts the narrative that markets are functioning, that oversight is sufficient, that the paper system accurately reflects physical reality. But the data does not care about comfort. The data does not adjust itself to protect anyone's quarterly outlook. The data simply accumulates. And right now, it is accumulating into a picture that the most serious economic minds are beginning to study very carefully indeed. The strategic window is not permanently open. Windows of this kind never are. They exist in the gap between when the data becomes clear and when the mainstream finally catches up to it. That gap, based on the velocity of the signals currently moving through this market, may be measured not in years, but in months, possibly less. The question every decision maker watching this analysis must now answer is not whether this data is real. The numbers are public, the vaults are measurable, the premiums are live, the Fed's balance sheet is published. The question is far simpler and far more personal than that. When the convergence arrives and the math finally stops being ignorable, which side of the information gap will you be on? Part 5 brings the full convergence. Every signal, every data point. One final conclusion. And the most important question this analysis has saved for last.